This is the second lesson of final accounts with adjustments. In this lesson, I'm going to answer a question of CPA May 2018, question number 1. This is a question about preparation of the final accounts of a sole trader. It is advisable for you to first look at lesson number 1, which explained in details the various adjustments to final accounts. Now, such adjustments, we are going to illustrate them here, but now not in details as we did in lesson number 1, because here we're just using them to answer the question, but we explained each and every adjustment in the lesson number 1 of final accounts with adjustments. The question reads as follows. Asuba Enterprises is a business run by a sole trader. The following trial balance was extracted from the business as of 31st March 2018. Right, so this is a trial balance with the following items: capital, inventory, sales, purchases, electricity expenses, discount received, purchases returns, discount allowed, motor vehicles, running expenses, drawings, balance at bank, salaries, insurance, trade receivables, irrecoverable debts, allowance for receivables on 1st April 2017, trade payables, general expenses, loan 9%, interest on loan, land and buildings, accumulated depreciation on land and buildings, equipment at cost, accumulated depreciation on equipment, motor vehicles, accumulated depreciation on motor vehicles. In the additional information, in number 1, only 10 months salaries are shown in the trial balance. An equal amount is paid for salaries each month of the year. Number 2, as of 31st March 2018, 32,000 had been prepaid for insurance, while 41,000 was going for general expenses. In number 3, 46,000 had been charged to general expenses for the owner's private holiday. Number 4, as of 31st March 2018, inventory was valued at 225,000. Number 5, a customer owing 50,400 had been declared bankrupt. This amount was due to be written off in full. An allowance for receivables is to be maintained at 3% of the remaining trade receivables. Number 6, as of 31st March, land was valued at 1 million. Land is not to be depreciated. Depreciation is to be charged as follows. That is in number 7. Buildings 4% on cost, equipment 25% on cost, and motor vehicles 40% per annum on reducing balance basis. There was no additions or disposals of non-current assets during the year. Required. Statement of profit or loss for the year ended 31st March 2018. Statement of financial position as at 31st March 2018. Right, we start answering this question by preparing the statement of profit or loss as follows. Now, as we do this, we are referring to the format that we already learned in lesson number 1. So you may need to look at lesson number 1 so that you can be able to understand the format well, the format of the statement of profit or loss. We explained each and every item in that particular format of the statement of profit or loss. This is Asuba Enterprises. Statement of profit or loss. For the year ended 31st March 2018. Right, so we need 3 columns. as follows. And on top of every column, we write shillings, without shillings. We start with the first item, which is sales. The sales equal to 4,214,500. This question, we don't have return inwards or sales return, and therefore we go right away to deduct cost of sales. So we say less cost of sales, less cost of sales. And the cost of sales starts with opening inventory or opening stock. And the opening inventory is found here. The opening inventory is 242,000. So we have 242,000 as the opening inventory. And then after the opening inventory, we have purchases, add purchases. And the purchases we're going to adjust. So we write the purchases in the first column, then we make adjustments to the purchases. Purchases equal to 1,673,500. 1,673,500. Then you make adjustment by saying less, return outwards, or purchases return. We can call it purchases return, less purchases return. And purchases return is this item here, which is equal to 60,400. 60,400. We don't have carriage inwards again, and therefore we don't need to put it anywhere. We just assume it because we don't have carriage inwards. So now we want to subtract 60,400 from 1,673,500. We subtract 60,400 so that we get 1,613,100, which is now known as net purchases. That is the net purchases. Net purchases. Net purchases should be added to the opening inventory, 1,613,100. If we add to the opening inventory, which is equal to 242,000, we are supposed to get 1,855,100. From this, we need to deduct the closing inventory, less closing inventory. But before less closing inventory, this item is known as goods available for sales. Goods available for sales. It is known as the goods available for sales. Now, from the goods available for sales, we less the closing inventory. That is to mean that the goods which were available, some were sold and some were not sold. So we subtract what is remaining. So from the goods available for sales, less closing inventory. The closing inventory is found in the additional information number. That should be number 4. We are told that as of 31st March, the closing inventory was 225,000. So we subtract 225,000, which is the closing inventory. And if you subtract the closing inventory, which is 225,000, we are going to remain with a total of 1,000,000, going to have 1,630,100. 1,630,100. And this is known as cost of goods sold. And this cost of goods sold is equivalent of the cost of sales because we were determining the cost of sales. So at this point, the figure we're getting is the cost of sales that we have been determining. Therefore, this particular item here, cost of goods sold, is this particular item which we started determining there, the cost of sales. So cost of goods sold is the cost of sales. And the cost of sales we subtract from the sales. We subtract cost of goods sold from sales. If we subtract cost of goods sold from sales, we are going to get a figure known as gross profit. And the gross profit which we are getting is equal to 2,584,400. That is the gross profit. So we call it gross profit. Gross profit. After determining the gross profit, then we check whether we have other incomes that we need to add to the gross profit, because to the gross profit, we need to add other incomes. To the gross profit, we need to add other incomes. And the other incomes include the following. First, we check if we have discount received, because that is an income. Discount received here is part of those incomes. So we add that discount received, which is an income. Discount received is equal to 42,700. We also check if there are other incomes that we may add. And the next income that we may have, we check in the provision for bad debts. If the provision for bad debts is a decrease, then it becomes an income and should be added. Therefore, we say this. In the provision for bad debts, we are told the following, in the additional information number 5. A customer owing 50,400 has been declared bankrupt. This amount is due to be written off. An allowance for receivables is to be maintained at 3% of the remaining accounts receivable or trade receivable. Let us look at the trade receivables. And the trade receivables here is equal to 1.1 million. 1.1 million or 1,101,400. 1,101,400. So we check there in the trade receivables of 1,101,400. First, we subtract the bad debts, which is to be written off, which is 50,400. And if you subtract 50,400, you're going to get a total of, subtract 50,400, you're going to get a total of so there we have 101. This is provision for bad debts or allowance for bad debts. So for bad debts, we have so for the receivables, we have a total of 1,101,400. So we have 1,101,400. If we have 1,101,400, then we say that 1,101,400 minus 50,400, which is to be written off according to additional information number 5 here. This is to be written off. So we write that off, and we're going to remain with 1,050,100. 1,050,000 and 51,000. So we have 1,051,000 1,051,000. That is what is remaining. Then from the 1,051,000, we are told that the allowance for bad debts equals to 3%. So 1 million. So allowance for bad debts, therefore, or allowance for receivables, 1,000. That is multiplied by 3%. If we get 3% of 1,051,000, will be equal to 31,530. That is 31,530. 31,530. So at the end, the provision allowance for bad debts is 31,530. Let us see at the beginning. At the beginning, allowance for bad debts or allowance for receivables is 31,530. In that case, there's no increase because at the beginning, 31,530, at the end, 31,530. If there is no increase, no decrease, there's no expense, there's no income. So then the only additional income is the discount received that we have recognized already. After the discount received, or let us add the discount received so that we get the total after adding the discount received. After adding the discount received, then we are having 2,627,100. 2,627,100. Let us continue, and we need to subtract or less operating expenses. Subtract operating expenses. In the operating expenses, I would like to start with the additional information so that we are sure not to leave any additional information behind. We ensure that every additional information is taken care of and is treated information to ensure that we are correct with the additional information first before we go to the other items, the trial balance. Number one is about salaries. And we're told that salaries, only 10 months salaries are shown in the trial balance. That is to mean in a year with 12 months, if only 10 months salary is shown, and we're told that salaries is equal for each and every month, that means 2 months are not yet shown. So we're going to say that salaries per month is equal to the salaries for 10 months, and the salaries for 10 months, in this case, is equal to this. 1,080,000. So we have 1,080,000 for the salaries for 10 months. So divide it by 10 so that we get the salaries per month, and the salaries per month will be 108,000. 108,000. That is salaries per month. So if salaries per month is 108,000, then for 12 months, so for 12 months, so salaries for 12 months is going to be 10,016,000, which is the salaries for the 2 months which has not been added. So therefore, salaries, we're going to say salaries equals to 1,080,000 plus 216,000. 216 is what has not been added yet. So then we're going to have total salaries expense to be 1,296,000. That is the total salaries expense. In additional information number 2, we are told that as at March, 32,000 had been prepaid for insurance, while 41,000 had been prepaid for general expenses. Let us start with insurance. Insurance equals to the amount which has already been paid. The amount which has already been paid is inside the trial balance as 154,000. Therefore, we are going to say 154,000 for insurance has already been paid, but 32,000 has not been paid. So subtract 32,000 from 152,000 so that we have 122,000 as the insurance expense. Prepayments are usually deducted from the amounts already paid so that we determine the actual expenses in the statement of profit or loss. The next one is general expenses. The general expenses has two additional information. The first one is the one for prepayments. So general expenses is 67,800. But we have another information, which is in the additional information number 3, saying that 46,000 had been charged to general expenses for owner's private holiday. So the amount for the owner's private holiday, that should be not a business expense, but a personal expense. And big personal expenses are not supposed to be paid for by the business. And therefore, if paid for by the business, then that is considered to be drawings, as if the owner has withdrawn money from the business for personal use. So we therefore subtract 46,000. This 46,000 that we subtract from the general expenses should be added to the drawing, because it is like the owner of the business has taken money from the business for personal use, and that is drawings. So we have 67,800 minus 46,000, and also minus 4,100, which is prepayment. So prepayment 4,100, and with drawing of 46,000. So we have 67,800 minus 46,000 and minus 4,100. The total of that is equal to 17,700 is now the amount for general expenses. In the additional information number 5, we have done number 4. Number 5, a customer owing 50,400 has been declared bankrupt. That means bad debts written off. So we say bad debts written off. The bad debts written off there is equal to irrecoverable debts, which is in the statement of profit or in the trial balance here. Irrecoverable debts is 14,200. So we start with 14,200, which is irrecoverable debts, plus the one to be written off, which is 50,400. So we add these two, 50,400 plus 14,200. That should give us 64,600. 64,600. That is the total expenditure for bad debt. Provision for bad debts, we have confirmed that there is no increase, and therefore, if there is no increase, there is no expense for provision for bad debts. There is no increase in the allowance for bad debts, therefore, there is nothing to enter. Let us look at additional information number 6. This is the value of land. And in additional information number 7, we have depreciation expense. And for depreciation expense, we say there's depreciation on, start with buildings. For depreciation on buildings, we have determined that the value of land is 1 million. And the cost of land and building is 3.4 million. So remove land from the cost of land and building, so that remains the cost of buildings alone. The cost of buildings alone is 2.4 million. Now, 2.4 million times 4% is equal to 96,000. That is the depreciation on buildings. Then we have depreciation on equipment, which is 25% on cost, and 25% on cost of equipment. The cost of equipment is equal to 220. So we say 220 times 25%. 220 times 25%, that becomes 55,000. The next one is depreciation on motor vehicles, and this is on reducing balance method. So depreciation on motor vehicles is on reducing balance method times the reducing times the 40% times the net book value of the motor vehicle. The cost of motor vehicles is 260, and the accumulated depreciation is 132,500. So we have 132,500 minus, now we have 260,000 minus 132,500. And that is equal to 127,500. And 127,500 times 40% is equal to 51,000. So that is all with the expenses in the additional information. Let us look at the other expenses in the trial balance that we have not looked at in the additional information. There are some expenses which are in the trial balance, but they don't have any additional information. They don't have any adjustments, and therefore they are picked directly the way they are. So such expenses will include the following expenses. The first one is electricity expenses, discount allowed, motor vehicle running expenses, interest on loan. Let's start with electricity. Electricity expenses. And electricity expenses in this case equals to 22,300. So we write 22,300, followed by discounts allowed. Discount allowed is another expense. Discount allowed is another expense, which is equal to 24,200. That is followed by motor vehicle running expenses. Motor vehicle running expenses. Motor vehicle running expenses, which is equal to 15,800. The next one is interest on loan. And we are told that interest on loan is 9% because we are told here that a 9% loan, that is to mean that the interest on loan is 9%. So we need to check whether the correct interest was paid, because assuming the correct amount was not paid, then we just consider 9% of the loan as the interest. The loan is 1.5 million. 9% interest on that amount, that is 1.5 million times 9%. So interest on loan is equal to 135,000. If we compare that with what was paid, interest paid here was 120,000. That is to mean 15,000 has not been paid, and that is part of the accruals. 15,000 of the interest on loan has not been paid, and that is part of accruals. That is accrued interest, meaning that should be paid. It has not been paid, it should be paid. So these are all the expenses. These are all the expenses. So we need to add all the expenses to get the total expenses. We need to get the total expenses by adding all the expenses as follows. The total expenses is equal to 1,899,600. This is the total expenses. We now deduct the total expenses from the total income above there, which is equal to 2,627,100, so that we get net profit. The net profit in this case equal to 727,500. That is the net profit. And that is the end of the statement of profit or loss. That is the end of the statement of profit or loss. We have incorporated in the statement of profit or loss the adjustments, and we have seen how to adjust each and every item that requires adjustment. We now have a full statement of profit or loss as follows. Therefore, a full statement of profit or loss for the question is shown as follows. Having prepared the statement of profit or loss very well, and we have determined the profit for the period, let us now prepare the statement of financial position for the business. Asuba Enterprises. Asuba Enterprises. The statement of financial position. As at 31st March 2018. Right, so we start with the non-current assets, but on top here we have amount in shillings. So we start with the non-current assets. The non-current assets are accounted for in terms of the cost of the asset, accumulated depreciation of the asset, and then we have the net book value of the asset. So we have the cost, the accumulated depreciation, and the net book value. Beginning with the first non-current asset, which is land and buildings. The cost of the land and buildings, in this case, equal to 3.4 million. And therefore, we're going to have 3.4 million in the first column. And then accumulated depreciation for land and building is determined as follows. So we have accumulated depreciation . We start with the land and buildings. So for the land and buildings, we have at the beginning, the accumulated depreciation of land and building was 260. So we start with 260. And during the year, accumulated depreciation was calculated on building, which was 96,000. So that we have a total of 356,000 as the accumulated depreciation on land and buildings. So we have 356,000 here. Subtract 356,000 from 3.4 million so that we get 3,044,000. 3,044,000. That is followed by equipment, which is the second asset. For the equipment, the accumulated depreciation of the equipment at the beginning of the year is 103,000. And during the year, some depreciation was calculated. So for equipment, we are going to have 103,000 plus 55,000, which was determined during the period. So that the total accumulated depreciation is going to be 158,000. So we write here 158,000. Beginning with the cost first, even before we go to 158,000, the cost is 220. The cost of equipment, maybe let me just show you that. The cost of equipment is this amount, which is 220,000. So we have 220,000. Accumulated depreciation is 158,000. So that the net book value is 62,000. The next asset, non-current asset, is motor vehicles. For the motor vehicles, to begin with, the cost of the motor vehicles is 260,000. Accumulated depreciation at the beginning was equal to, so at the beginning, accumulated depreciation on motor vehicles is amount of 132,500. So we have 132,500. During the period, depreciation of 51,000 was calculated, so that the total now should be equal to 183,500. 183,500. So we have 183,500. That means, therefore, the net book value for the motor vehicles is equal to 76,500. 76,500. And now we need to determine the total net book value of all the assets, which will now be equal to 3,182,500. 3,182,500. That is the net book value of all the assets. And after non-current assets, we need to go to current assets. And the current assets for this organization will include the following. The first current asset that we have there is inventory, which is the stock. Of course, we usually start with the stock, or we start with the inventory as the first non-current asset, as the first current asset. So stock in this particular example is equal to 222,000, 225,000. So we have 225,000. That is followed by accounts receivable or trade receivables. For the trade receivables equal to 1,101,400. From there, we subtract debt to be written off, which is equal to 50,400. There are some debts which were to be written off, equal to 50,400, as you can see here. So we subtract that amount of 50,400. Also subtract the debts which are not the debts which are recoverable. Subtract the provision for bad debts at the end of the period. And we determine that provision for bad debts at the end of the period is 31,530. 31,530. And if you do that, then you'll find that the total of this is 1,019,470. 1,019,470. Then we have prepaid expenses, which included prepaid insurance income expense, prepaid insurance of 32,000, and also prepaid general expenses of 4,100. So we are therefore going to have prepaid insurance to be 32,000, and also have prepaid general expense 4,100. After that, we have bank balance, because we don't have the cash balance, so it is just bank balance. There is no balance for cash. If you look at the trial balance here, there is nothing about cash, but only about bank. So the bank balance there is equal to 245,110. 245,110. Now we determine the total of the current assets to be equal to 1,525,680. 1,525,680 is the total current assets. Total current assets. Right. Let us extend these statements because we're still continuing downwards. we can extend it so that it can accommodate all the other transactions that we will enter. Right, so after that, then we go to current assets, current liabilities. After that, we go to current liabilities. And the current liabilities, in this case, starts with payables, trade payables. And the trade payables in this example is equal to 762,880. So we have 762,880. We add accruals, and in this case we had accrued salaries, which is the additional information number 1, and we found that accrued salaries expense equal to 216,000 to 16,000. And then there was interest on loan. For the interest on loan, a total of 120,000 was paid, but we determined that the total interest on loan, which is 9% of 1.5 million, 9% of 1.5 million, we determined to be equal to 135,000. But only 120,000 was already paid. That means 15,000 has not yet been paid. And the 15,000 which has not been paid is amount which is payable, and therefore we say interest payable. Interest payable is equal to 15,000. Let us now determine the total of current liabilities. Total current liabilities equals to 993,800. 993,800. And this amount should be deducted from the total current assets. So total current liabilities, we need to deduct from total current assets. If we deduct that, then we are supposed to remain with 531,800 is what is remaining. So remain with 531,800. And 531,800 is known as net working capital. Net working capital, which we need to add to the non-current assets. So net working capital, we are adding to the non-current assets, the total for non-current assets, which is up there, so that we get a total of 3,714,300. 3,714,300. From this amount, which is 3,714,300, we will deduct non-current liabilities or long-term liabilities. Non-current liabilities is the 9% bank loan. 9% loan. It's not bank loan, but 9% loan. So the 9% loan is 1.5 million. If we subtract the 9% loan, which is 1.5 million, we are remaining with 200. We are remaining with 2,214,300. 2,214,300. Then we say financed by financed by capital brought down. And the capital brought down in this particular example, that is capital at the beginning of the period, is equal to 1,852,800. So we have 1,852,800. 1,852. 1,852,800. 1,852,800. To that we add net profit. So add net profit. Add net profit. And the net profit equal to 727,500. Then less drawings. Drawings at the beginning of the periods. Drawings for the business equal to 320,000. So we have 320,000, but we are also told 320,000. We are also told that in the additional information number 3, that 46,000 had been charged to the general expenses is for the owner's private holiday. So it is like the owner took some 46,000 from the business and used it for private purpose, which is private holiday. That amount for private holiday is like drawings that the owner took from the business. When the owner consumes money from the business, it is part of drawing. So the 46,000 then will be drawings. So then we add 46,000 to 326,000, so that we're going to have a total of 366,000 as drawings. Now let us subtract 366,000 from the sum of capital brought down and the net profit. So we have a total of 2,214,300. And that is the same as the amount we got up there for the net assets. So the net assets that we determined was equal to net assets here. So net assets was equal to 2,214,300, and also capital carried down, or capital at the end of the period, that is the net capital. The net capital also equal to 2,214,300. That therefore means that they are equal. We have been able to balance the statement of financial position, which is equal to 2,214,300 and 2,214,300. So the capital of the business is equal to net assets. Remember, from the accounting equation, we say that net assets equal to capital, and net assets is equal to net assets is equal to assets minus liabilities. From the accounting equation, assets minus liabilities equal to capital. So that is what we have been able to do here to determine that the net assets here equal to the capital of the business. All of them are 2,214,300, 2,214,300. That is how to prepare the statement of financial position. So this is the statement of financial position of the business in one single page after we have balanced it.